We've heard so many guests, and I've had many guests this week as well, trying to divine what the market means for the economy. Let's shut our eyes to the market volatility, Lynn. Just tell me your impression of recent economic trends, fundamentals of the U.S. economy over the last several months, and try to tie it up as to what it may mean for the future void of the market.
Well, Rick, the economy looks actually to be quite strong. We've seen recent economic information to be solid. You reported this morning the Chicago Purchasing Managers Index was good for December. We've seen strong retail sales. We've seen good numbers on industrial production. So the economy seems to be quite solid. It's in sharp contrast to the financial markets, which are much more gloomy. The truth is probably somewhere in between in terms of the outlook for 2019.
You know, my personal experience, first time I encountered really wild volatility was the '87 crash, and it wasn't a signal for a recession, and it was meant to be purchased, actually. But the times we live in, capital moves so much faster. What about the global exporting of some of the weak fundamentals, as we've seen just in the last 36 hours with regard to Japan in particular and Europe in general?
Well, the world economy is probably the greatest risk to us here in the United States, but we are not nearly as exposed to international trade as many countries, so that represents some buffer. Our real strength is the consumer sector. That's about 70% of our economy, and consumers at this point are still hanging in there. They're having jobs, they're getting larger wage increases, and they still like to spend. So as long as consumers stay in the game, we're probably still in pretty good shape.
Now let's switch gears a bit. I found a very fascinating article in today's Wall Street Journal talking about company buybacks, and it mentions several companies' buyback performance. Apple down $9.1 billion on their buybacks. Wells down $2.7 billion. Citigroup down $2.8 billion on their purchases this year. Applied Materials down $1.8 billion. Listen, if these companies, banks, if they invested in an actual entity or a business that lost that much this year, as the article pointed out, people would be upset. What should we think about this negative performance in buybacks?
Well, companies, of course, are the ultimate long-term investors, so they're not any better at timing the market than any other individual. And companies did see a large windfall this year because of the tax cuts, and they basically have three options with that extra cash. They can indeed just hold it as cash. They can invest in their companies with planned expansion, paying employees more or buying other firms, or they can give it back to shareholders in terms of dividends or share buybacks. And many of them chose a variety of those options, but the buybacks was a major element.
Very good. Lynn, thank you. You know, just as an aside, I know that personally, maybe they should have considered giving their employees a bit of a raise. The money's sort of gone. I understand the stock can come back. Always different ways to think of these things.